and gentlemen, good evening. This is Christopher Aaron. It is late on the 24th of May, 2017, and the metals are in a consolidative state right now. They are continuing to hold the patterns that we've been watching for the last number of weeks and months. And so I wanted to take this opportunity to focus on the gold mining sector, the GDX. I know a lot of people are invested in the juniors and some people in the seniors. And I want to focus on the GDX for this video, and I'm going to do something a little different, which is not just to show the charts that I've already created, but I've had some requests for this, which is to get into how I actually go about charting and how I make sense of these markets, the system that I'm using. So I actually want to go through the GDX with you this week, step by step, and show you how I make sense of a market, and we'll focus on the gold miners because it is such an important sector for those of us who are paying attention to the precious metals. And even if you're not investing in the gold miners yourself, it would be worth your while to keep track of what is happening in the GDX, because the gold miners do often tend to lead the metal itself at certain junctures. So let's take a look. We'll switch over to the other platform. Okay, so this is obviously going to be a different video. This is for those people that want to start to learn to do this for themselves. There's the old saying, you can give a man a fish or teach a man to fish, and I hope to offer a little bit of the educational component here in this video. So we are at the stockcharts.com site. I have no affiliation with them other than I use them. It's one of a number of different charting services that I use. I use stockcharts.com for my macro charts and also my individual mining equity charts. I just find that it's the most clear visually. It allows me to see what is happening the most clear, although there are some other good services, of course. So I'm just going to go right up here and type in GDX. And of course, the GDX is one of a number of indices that cover the gold and silver mining sector, but it tends to be the broadest. This is a basket of about 50 different gold and silver mining companies, the larger ones. We also have the HUI index, and we have the XAU index, which are slightly different in their composition. Then, of course, you have the GDXJ, which gets into more of the mid-cap, and you have the GOEX fund, which is some of the real small companies in the space. Anyway, here we are looking at the GDX, and we are looking at this over the last 18 months. This is sort of my default view. And just so you have a sense of what is happening here, so let me get rid of this, inspect. So the price of the GDX fund, which is an average, we're talking, this is a stock, it's an ETF, and this trades on the exchanges just like any other stock would. This fund started 2016 down here right around 13 and a half, and we saw the strong rise out of 2016 out of the lows up to almost 32. So you had about 160% advance here in just a little bit under 6 months, and then you had this pretty severe correction in the GDX. And then you've been in a real consolidative type of mode here, just a back and forth, up and down consolidation here happening for the better part of 2017. So here we are looking at the price of the fund, and right below it here, kind of in these faint bars, this is the volume indicator. Okay, so we are looking at the number of shares that were traded on every single day. So for example, the most recent day here you can see was just about an average, slightly below average level volume. This volume here corresponding to the figure on the left side, about 50 million shares traded here, plus or minus. We're looking at average figures here. We're just trying to get a sense of where the big volume spikes are. So for example, here on this day, you could see this in the beginning of October. This was the highest volume day that we've had on the GDX all year, and this occurred on this down day in the GDX. So there was a big, strong down day on a lot of volume. And if you'll notice, the point at which this candle started here. The candle refers to a specific day of price action. If you'll notice, the GDX has failed to really exceed this level here. You just made a brief attempt to overcome this 25.5 level here, but a failure to do so thus far. So when you see a strong down day on high volume, the market will often have trouble exceeding that level on the next attempt. So this explains why we are seeing the GDX consolidate now. You have a lot of people that are still underwater back here from October, and they were choosing to sell here once the price got back to this level for this strong down day. So conversely, we can see some of the strong up days that we've had here in black. This was on the last Fed interest rate hike. So you had a strong volume day there corresponding to this rise right here. So we have the price and right below it we have the volume. Now above the main chart, this is the relative strength index. This is an indicator. It's a derivative of the price here. It is based on the price. And what this is a momentum indicator. And basically, I don't want to spend too much time talking about these different indicators, but I want to tell you that when the RSI starts to move above this 70 level here, it tends to correspond with a market that has moved strongly higher over the preceding several days and several weeks. And when a market is moving too quickly, too fast, it can correspond with a short-term top. And conversely, when a market is moving too far down too quickly, this RSI will go below the 30 level here, which gives us a sense of a short-term bottom that may be forming. For example, here you touched the 30 level on the RSI, and it corresponded to this major bottom in December. So that is what's at the top of the chart. So we have the RSI momentum, we have the price of the fund itself, we have the volume of the fund itself, and at the bottom, I almost always will show the fund in question, the GDX, the gold and the silver miners, compared to a related asset class. So this is the GDX compared to the S&P 500. The S&P 500 is the large cap US equities, the 500 largest stocks in the United States. So we are comparing the largest gold mining companies with the largest companies in the broad stock market. And so what you can see, this is a ratio. And so when this ratio is moving up, it's telling you that the gold miners are outperforming the broad stock market. And when the ratio is moving down, it's telling you that the broad stock market is outperforming the gold miners. Okay, so this is on the 18-month time frame, and we're looking at a daily view, 18 months. And what I want to do is to back this out, and we're going to switch it over to a weekly view. So I go down here to the chart attributes, we switch over to a weekly view, and if we update that, what it's going to do is turn every 5 days of bars that we saw on the previous chart now is one of these bars. So each of these bars now represents 1 week. And I'm going to back this out to, let's say 6.5 years. Let's see how this looks. Let's even make it 7 years. Okay, so we want to see what is the big picture perspective here. We're talking the 7-year time frame of the gold and silver mining sector. Now, it's easy to look at this chart from a high-level perspective and to just say, well, the gold and silver miners have been moving down over the last 6 or 7 years. And yeah, from a high-level perspective, that absolutely is true. But there's a lot more going on here, and here's where I'm going to introduce you to the way that I form some level of reason from these charts and get a sense at the trends, at the turning points, at the momentum indicators, and what is actually happening here. What is the big picture of the gold and silver mining sector? Okay, so what we're going to do now is annotate. So this is the tool here. I'm going to click annotate. This switches the chart over into a mode that allows me to basically create trend lines and every sort of other technical study that you could ask for. And I want to take you through, this is how I approach every single market that I am studying, and this is the system that has worked for me. And other systems work for other people. I've been fine-tuning this over about a decade, and this produces the best results for me. Now, does it produce 100% results? No, no system ever will, including the largest banks in the world. As we saw in the crash of 2008, major banks can have their entire system wrong, and so we should never think that we have anything perfect or 100%. But what we do want to do is find a system that works on a balance of probabilities. And I believe that this is a high balance of probability system. So where I like to start when I am annotating, once again, we're looking at the gold and silver mining sector, and we're trying to figure out what's really happening here. Where I like to start is with this tool on the left. We are going horizontal lines, okay? And I like to see where my horizontal support and resistance levels are. So I'm going to draw this first line, and what we are looking for here visually are areas in which the gold and silver miners were unable to get over or to get below a certain point on multiple occasions. So let's go back to the highs here from 2010 and 2011. We can see, for example, this peak right here in 2010. So let's put this horizontal line right at that peak in 2010. And we'll let it go, and we'll drop it right there. Now, what can we notice here? This peak in 2010, notice that the gold and silver miners could not exceed this level right just below 62. And they came back down to the 50 level, tried to reach this again. Okay. Then you had this move where they exceeded the 62 level for just about a week or two and then closed back below that. Now, as a side note, those people who follow my analysis, what we would call something like this is a false breakout. This is one of the most ominous signals that you will see in any market, especially when it occurs at an all-time high, and especially when it occurs after a period of consolidation at an all-time high. Now, if you go back to the video from 1 week ago, we were talking about the US dollar. And this is a big part of the lesson that I have drawn for the US dollar. This example in the gold mining sector, this false breakout that formed here in 2011 was the signal that a major reversal was starting that was going to last for the next 5 years. I digress. That's not what I wanted to focus on right now. I wanted to focus on these support and resistance lines. So we're looking at a point at which the gold miners could really not exceed this level. And when we have multiple times here where the market could not exceed a certain level, this makes it even more strong. It's telling you that there are a lot of sellers showing up there. So what I like to do when we have multiple hits like this in a region, I like to actually draw two horizontal lines. And so what I do is I consider this a range. So we go from the lowest right here attempt at this range to the highest attempt at this range. And then I would just draw a call out, and I would call this resistance zone. Okay, so this is, and I want to be a little bit more specific here. We will call this long-term resistance zone because we're talking about something that goes back many years, and this was the previous all-time high in the gold and silver mining sector. And I want to make that a little bit bigger so we emphasize it. Okay, so we're talking about a really important resistance zone here up around this 60 to 64 level. Okay, so again, for perspective, we're nowhere near this level right now, right? We are talking the gold and silver miners closing right around 23. So you would be talking almost a tripling in value if the average gold and silver miner were to get back to its former all-time highs. And this matched the gold price at 1900, right? So we're talking a gold price that would be about $650 higher from here. The average gold and silver miner could be expected to appreciate 200% in that same time frame, all else being equal. Of course, all else is never equal, but we sometimes do have to make basic comparisons so we have at least an expectation of what we might be expecting here in the market going forward. Back to the horizontal support and resistance levels. So long-term resistance zone is what we have here between 61 and 64 on the GDX. Let's look at some other levels. So this is always what I do first when I'm annotating a chart. Let's look at some other levels here. Let's call this level right here where we made this high in 2016, right below 32. Okay, so notice this level right below 32 very closely matches this level from 2013, right around 30.5. Okay, so you have clearly a zone here. You can see the price of the GDX after the big part of the fall made an attempt to come back up and get above 30, failed. Some attempts that didn't even get that close got to around 27, 28. The final part of the plunge. So it was not random at all that the resistance came in here right at this same level as the 2013 level. Okay, so we don't need to annotate every single level here, but I just wanted to show you that I believe this level between 30 and 32 or so, if we are using another form of analysis, I would call this your stage 1 base resistance. Okay, and this is another form of analysis I'll go into another time. But when you see a market, and let's make that a little bit smaller, when you see a market that has gone down for a number of years, and one of the things I don't like about stockcharts.com is that it is sometimes challenging to get the exact points that you want there, but there we go. When you see a market that has fallen for a number of years and then have a clear basing pattern, that is, the market has stopped falling and is now trying to get back above a short-term peak here, we would call this entire thing a stage 1 base. Stage 1 bases tend to be the most powerful patterns to invest in, the times to invest, but they are not met with a whole lot of fanfare. These are times in which the market was moving lower, so no one's interested. There may be a strong advance, but then you have more consolidation, so people become disinterested again. But certainly investing anywhere in the stage 1 base time period is going to be very powerful when a market finally breaks above its stage 1 base resistance and starts to advance again toward a more long-term resistance zone. So we are creating here the support and resistance levels that we should be paying attention to. Are there any others we should pay attention to? Yes, I want to call this level out right here. Let's call this a zone. Once again, we see this spike low and this spike low very closely matching up between 37.5 and 39. Okay, and there are some less important resistance levels here that we could focus on. I would generally make those in a slightly lighter color, such as this support here right around 18.5. We might want to focus on that, and then maybe this swing level here right around 52. So this is how I would show the GDX. Right now, though, since we are on the long-term perspective and we're trying to get the idea, big picture, right? Big picture, what is happening here in this sector? I just want to keep the major swing points on the chart. I don't want to put any of the other resistance levels here other than the major ones. Okay, so these are the levels from a horizontal standpoint. So what are we talking about here fundamentally? Buyers, right? Buyers who in 2013 bought at this level, let's say around 30, and then the market moved against them and it went down, down, down. What happened here? When the price finally got back up to the 30s, these people here sold at break even. So the market got back to where it was a few years ago, and the people who were holding for these number of years underwater said, finally, I'm back to even, get me out. I'm done with this thing. And they sold, right? So that is what accounts for these repeated attempts at a similar resistance level. Okay, so having looked at the horizontal support and resistance, I want to focus on something else that I think is very important, and I believe this is something of a lost art, and we are talking about trend lines. Now, trend lines are exactly that. They help us to identify a trend. And trend lines get a bad reputation in the technical analysis community. I think because there is this predisposition to want to focus on the most complex form of technical analysis possible. There's the desire to want to make things complex so that we seem perhaps more sophisticated, or the analyst seems to have some real exotic form of, of analysis that only they can understand. And so for that reason, I think that trend lines have become a lost art in this form of analysis. And why is that? So what is a trend line? Well, a trend line connects, at the very basic form, it connects two peaks. Two peaks or two troughs. So for example, let us look at the trend line that is formed here just recently. And I like to color code my trend lines. Yes, I like to make things look pretty and eye appealing, but it's not just about eye appealing. It's also eye catching. I like to have my trend lines really catch my eye and really show me from a quick glance what is actually happening here, so that I don't have to guess so much. So the colors have a reason in my system. So blue is what I consider primary trend lines. This is the primary trend in question over let's call it an intermediate term time frame, either at least a couple of months, including a couple of years. And so this trend line here, look, all we are doing is connecting the bottom point of the market from early 2016. You can see that. Let me move it out of the way. The bottom right here with the next major bottom, which happened right here at 18 at the later part of 2016, and then this swing low. So we start with 2, right? We start with 2 points. All it requires is 2 points to make a line. We know this from basic geometry. And there's our line. And if we extend that out to the present, do we get a third? Yes, we do. The most recent hit right here. Okay. So these trend lines are not random, and we can't just draw them anywhere we want. There has to be some sort of a rhyme or reason. So for example, I would not want to have drawn, let's say, a trend line like this, okay, because I would have been ignoring this bottom that formed here, and then I would have had a faulty conclusion as to the significance of this move. So we have to connect important lows or important highs. And so what we're talking about is that there is something of a primary rising trend that is started from the bottom in 2016 and held through this pretty important low here at the end of 2016, and is continuing now through this most recent low just a couple of weeks ago. Okay, primary rising trend off what looks to be like the all-time low. So this is going to be an important one to follow. Let's look at some other trend lines. And here I'm going to change, this will show you why these are so important. Now I'm going to change the color so you can see this. I like to use this color here, this magenta color, as to really indicate long term. So we're talking multi-year or sometimes even multi-decade trend lines. Okay, so these are the things that we have to keep in the back of our minds, but then again, they may not be so prescient as the primary trend lines in the here and now. Okay, this might have more of a long-term multi-year impact. So what can we see here? So let's connect major points. Okay, now what I'm going to do is start by connecting the all-time high. We always have to start a trend line from an all-time high. If there's an all-time high, that has to be the place where we begin a trend line. Similarly, here was an all-time low for this move, for this bear market, and we are beginning a trend line here. So I would connect these 2 points to start. Okay, now I can see already some people would be saying, well, why aren't we connecting this all-time high with these lesser highs, something like this, right? And at the time, I would have said, absolutely, we should be doing that. Look, you can see 1, 2, 3 hits right there. And let's just continue this line down and see what happened here. Okay, so there was a break, right? So the price of the GDX had fallen all the way from 60 down to 38, and then it broke this trend line higher. Now, if we had continued this trend line, though, look at what happens. Something like this right in there. So you broke higher from this trend line. Let's get rid of that one so we don't confuse things. You had a legitimate downtrend forming here. So we're talking about sellers coming in at lower and lower levels. Then this was broken to the upside, and then the market just completely ignored it, right? Moving down, closing below it, back above it. So what happens with any trend is that eventually trend lines will break. Okay, so trend lines are valid until they break, and they can give us, therefore, a reasonable set of expectations what may be coming for the market over the intermediate future. But no trend line will last forever. So when a trend line like this is broken upward and then just really ignored by breaking down, up, multiple times, as an analyst, you have to say, well, something has changed in this market. Every market changes. If the market never changed, it would be no market. It would be a fixed price control system. So this market changed, and the levels at which sellers were showing up was no longer valid. So I would say that this trend line was no longer valid after perhaps this breakdown over here. And I would not include this trend line anymore in my analysis. So that's why, when I am creating the trend line now for the GDX, okay, and I want to switch this back to the solid color for the importance. When I'm creating a trend line now for the GDX, I will now connect these 2 highs. These are the 2 most significant highs. Clearly you had a strong retracement here off the 38 level. This high has to be respected. So let's continue this trend line down, down. I'll try to keep my mouse as steady as possible. Down, 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 down. Okay, now, what happened? Let's just try to get that. What happened right here at the beginning of 2016? We had a long-term trend line break. Can you see that? We're shading that right now. Long-term trend line break right in this region right here around 14. Okay, this was in February of 2016. Now, long-term trend line. Notice what happened after this very long-term trend line was broken. You had a 160% rise after a long-term trend line was broken. Now, it's no coincidence that I launched my premium service in February of 2016. Why? Because this is one of the things that I was paying attention to. So I was not out here on YouTube telling people in 2012 that they should be looking at this sector, nor 2013, nor 2014, nor most of 2015. I launched the premium service at the beginning of 2016, this being one of the reasons. There's a number of other technical signals that I was looking at. This was one of the most important ones. So what is the point here? And I'm going to get rid of, let's leave that up there. The point is, when you see a significant long-term trend line broken, it is telling you just that this trend of lower prices has ended. This trend, it's ended by definition. Okay, and so we had this strong move higher, and you are now forming something of a new primary trend higher. So for anyone saying that trend lines are not valuable, the gains that came from some of these miners last year when this trend line was broken, if you had just waited for this one signal and tuned out everything else, all the people telling you, to load up on gold and silver here in 2012, 2013, all the people telling you the dollar is going to crash in 2014 or 2011, if you had just waited for this one single signal, you could have tuned all of that out and said, this thing is still in a downtrend. Why rush it, right? Why try to guess when this trend will be broken? Why not let it be broken? So this is the power of the long-term downtrends and the breakouts that happen from these long-term downtrends. Okay, now, where does that leave us? We have a broken long-term downtrend, a new primary rising trend underneath a stage 1 base resistance. Okay, so I want to save this for a moment, and I actually want to extend this chart out. So I'm going to let's add another 2 years worth of bars. We can extend this out into the future. Okay, so let's go back to annotating. What would I like to see as a technical analyst? I'd love to see this hold, right? This trend line hold, get some grinding here throughout the summer, start to rise, perhaps make another attempt at this 30-31, back off a little bit in the winter of 2018, and then when you have a stage 1 base that has been forming for 5 years underneath a certain price level, the ramifications for the gains that can come after this are quite significant. This is what I would like to see. We're not there yet. We are right here. Okay, what else is important here from a technical standpoint? Let's talk about Fibonacci lines. Okay, so here's our Fibonacci retracement tool, and I usually use this. I usually go with a silver color for this. Now, Fibonacci, for those of you not familiar, was an Italian mathematician of the 1400s, I believe, and he was one of the individuals to observe that many things, well, in fact, all things in nature move in certain patterns. And one of the primary patterns that is found in nature is the Fibonacci sequence, the Fibonacci spiral. And the Fibonacci spiral can be found in things such as the shape of a seashell, the curvature, both inward and outward, of a seashell, forming that ever-tightening and ever-expanding spiral pattern. The mathematical formula to define a seashell is contained within the Fibonacci sequence. Okay, so another example are hurricane patterns or wave patterns in the oceans, flower patterns from rose petals, the way they branch out from flower. There are infinite examples of this in nature, and markets are a function of nature as well. They are a function of human nature. This is just another part of nature that we do not always recognize the patterns for, but sometimes we can recognize the patterns, right? So the Fibonacci tool, you will see this right here. And I make this light for a reason. So if it's hard for you to see, I do apologize, but I make it light for a reason. And that's because, as I said before, not every tool will be 100% accurate every time. So one of the major points of technical analysis is that when we have a confluence, okay, we have a confluence of technical levels all pointing to a similar target or a similar outcome, then that increases the weight of that particular target. So we're looking for a confluence here, but I don't want to distract. I find myself, I mean, you can see, for example, the stage 1 base resistance level here. You can see how clear and how important that was relative to this high from 2013, right? 3 years later, that same level tested and rejected again. So in my opinion, these horizontal levels, these trend lines are some of the most important tools. And then we have as an indicator that is sometimes confirming and sometimes not, Fibonacci retracement levels. So what you do for Fibonacci retracement levels is you connect, I'm going to go this way, you connect the absolute high right up here, which was just around, what is that, 64. You connect the absolute high, and let's extend that over to the right to make it pretty, and you connect the absolute low of an entire bull or bear market. I find that these tools are most important for major advances. Okay, now I'm going to make this a little darker just for the moment. I'm going to use a color that I don't usually use for this purpose, just so you can see it. Let's just put them in green for a moment. We'll make it a light green here or something like that. Okay, so what we're talking about with Fibonacci levels, these are retracement levels. These are levels where if you have had a strong move in one direction, such as we had here from 2011 to 2016, Fibonacci levels are levels that a market tends to see as a retracement. They can also be used for continuations, but let's focus on this as a retracement. You tend to see these as a retracement. They tend to be hit and then act as short-term pivot points or swing points. So notice where the 38.2, there are 3 primary Fibonacci levels between the all-time high, which is 100%, and the all-time low, which is 0%. We have 3 important Fibonacci levels. And once again, these levels are derived from nature. These are the ratios that are apparent in seashells and hurricanes and flowers as examples. So the first level of that natural ratio is a 61.8% retracement. The second level that is important is a 50% retracement. The third level that is important is 38.2%. And notice 38.2 is equally far from 0 as 61.8 is far from 100. Okay, these are 38.2 away from the high and the low. Now, to be really technical about it, 50% is not actually a Fibonacci level found in nature so specifically, but it is found quite often when we study the financial markets, and it is included in almost every Fibonacci retracement tool that we look at. So there are a few other Fibonacci levels here. I find them almost useless. The 78, what is it, 78.2? I might have got that wrong. 78.2, I believe. I find them almost useless. It's too close to the absolute high. I focus on these three. They work best for me. Again, if something else works better for you, bless you, and please use that system. This is for people who want to learn the system that I am using here. So we're talking the retracement possibilities. If this was a massive bear market and we are only looking at, let's say, retracement before the bear market continues, these are the levels that we should expect to see hit. And notice once again, 32.09 almost exactly matched this high from 2016. So this is not random. And as I said before, what's even more powerful than one or two technical levels pointing to a certain possibility is three technical levels. So we have three important lines here within about 2 points on the GDX. Very, very powerful resistance here, which is why this is absolutely a basing resistance. This is a critical basing resistance level to be monitoring if you are investing in the gold and silver mining sector. So what I am going to do, mind you, the next important retracement level will be right here on 38. Notice this is another important resistance level that we have. I would place the 61.8 as less important because there is not a confluence of other support and resistance levels as far as we can see at this time. So what I'm going to do, now keep in mind these lines are still on here. I'm just going to change the color to a very, very light. This is a very thin, light gray. You can still see the numbers here, but I have made them very light. Why? Because for me, this is what works best. What works best is to, if I take a step back, they say an artist always needs to take a step back. So for me, I take off my glasses. I literally take a step back from the computer and I allow my eyes to soften. I allow my eyes to lose their intensity of the focus and to instead look at the bigger picture. And for me, when I make the Fibonacci lines a lighter color where I can still notice them, but they don't detract from some of the important elements here, the more important elements that I see, this is the best system for interpreting the trends that we have available. Okay, so here's what we have so far. We have a market that was coming down for about 5 years that broke this long-term downtrend, had a strong move higher, gave part of that back, and is now consolidating. What else is important to pay attention to here? So let's take a look at, okay, let's look at the bottom of the chart now here. So as I said before, at the bottom of the chart, we are looking at the GDX versus the S&P 500. So we're looking at the gold mining sector versus the rest of the stock market. And we could do similar things. We can draw trend lines here, right? And so for example, we can see that the GDX was losing significant value versus the rest of the stock market. That trend line was broken here. We can see that. And what's happened here since 2014 is basically the gold and silver mining sector has been moving sideways versus the stock market. So this is one of these kind of sneaky little things to keep in the back of your mind. Now the stock market is getting all of the attention. The S&P 500 is getting all of the attention. Why? Because it's at an all-time high. It's been making numerous new all-time highs since Trump was elected. It's been moving higher for 9 years. But if you look at this ratio here, what you can see is that we have basically been moving mostly sideways here since late 2013, early 2014 as a ratio. Okay, since this line was broken. So what that's telling you is that after a major downtrend, you are now seeing a basing. You are seeing the gold and silver mining sector, it's no longer losing value relative to the broad stock market. It's not gaining value, but it's certainly not losing value relative to the broad stock market on this multi-year basis, right? What tends to happen next? You have something that's been going down for several years, something that bases for several years. All things considered, we would expect that after a period of basing, when one market is at all-time lows, meaning the gold and silver mining sector, yet the broad stock market is at all-time highs, this ratio, my expectation is that it is going to start curling up sometime here in the later part of 2017 into 2018. And from a level of 0.01 back to, let's say, 0.055, this would represent a 450% increase in the value of the gold and silver mining sector relative to the broad stock market, if this ratio was to get back to this historic peak. Now, there's nothing saying that has to happen this year or next year. Ratios like to revert, though. And when you consider that one market is at an all-time low, just coming off of an all-time low, and one market is at an all-time high, and that this ratio has stopped falling, I would say on a balance of probabilities, you are probably looking at a period of time where the next move to start happening is for the GDX to start outpacing the broad stock market. Does that mean to put all of your money into this one theme, this one idea? No, of course not. Absolutely not. You could do that. I'm not telling you to do that. It depends on how much you believe in the sector, how much you believe in the fundamentals and the technicals. Certainly one could have made excellent returns in other markets, cryptocurrencies, Amazon stock over the last couple months and years. So congratulations if you have done that. But I would say on a relative basis, I think there is immense value here in a sector that has broken a major long-term downtrend and now is starting to work on overcoming its basing process here. What else do I find important here? There are so many forms of technical analysis. You know, Elliott wave is often discussed in many circles. Personally, I do not find Elliott wave to be helpful. I have never seen it consistently used to identify what has a high probability of occurring in the intermediate future. I see a lot of wave structures that look very logical in retrospect, but I never see anything that is telling me definitively which wave we are in at the current moment. If it works for you, absolutely, once again, please use it. For me, it does not work as much as Fibonacci, horizontal support resistance, trend lines, breakouts, relative strength. Okay, let's talk about one more. I mean, guys, you know, I could, do I want to make this 2 hours long? I'll try to cut this off at 45 minutes or so. I don't have my clock running here, but one other important indicator that I would tell you for my system, if this system makes sense to you and you want to learn more about this, one other thing that I do think is very important is to follow volume patterns. We talked about that before. So once again, volume is below, it's behind the line of the GDX. Here's the GDX, And behind, you can see these bars here in red and black. Okay, the red just corresponds, this was a day when the sector moved down. Black is when the sector moved up, and we are talking about the volume. This is the number of shares that are being traded on any particular day. Now, I do want to make this sort of a more important color. Let's make this green here to really catch your eye, because there's something that's very important that's happening here. Now, as I said before, if we were to just look at the price level from right here where we are, 23 on the GDX, and we draw this back in a straight line, right? The GDX, basically, you could say as a sum that prices are where they were 1, 2, 3, 4 years ago, right? Here we have prices of GDX. We're at 23 back in the middle of 2013. So the price hasn't moved despite these wild oscillations, right? And the incredible enthusiasm, and then the horrible feeling of seeing the market tank against you, and this grinding bit of consolidation that we're in right now. Despite that, we really have not had actually a whole lot of price movement in the grand scheme of things. What have we had? Let's move that out of the way. Look at the volume. So if we measure the average volume here, let's say in the beginning of 2013, okay, and we were averaging in here just above the 100 million shares per week. Each one of these, is 1 week. Notice how much the volume has been increasing through today, and we're seeing it pick up year after year after year after year, even though the price has not increased this time. So you're seeing the price is the same as what it was in 2013, but the volume, you can see this, the volume is getting big. Look at some of these average volume spikes coming in here, right? So you can see this divergence between price and volume. So I'm making that green. Volume increasing even as the price has not increased. This is an important sign of a trend change in the works. So we can't say that the volume is only increasing because the shares are cheaper, right? Because the shares are the same price as they were in 2013. What we're seeing is more interest coming into the sector. So what is happening is shares are being accumulated by certain individuals, by certain strong hands. Not every single week, not every single day. We do see some drawdowns as well. But when you see consistently higher volume coming into a sector as the price has been gyrating underneath a base resistance, the saying often is in technical analysis, volume precedes price movement. So you often see big volume spikes come into a specific stock sometime before a big move higher. And what we are seeing is this happening now for the last 4 years as a sum. So I just want to get rid of that, and I want to put this down here. But the point is to notice what is happening. I'm actually going to delete that because I think it distracts a little bit from the trends. But just allow your eyes to look at the volume coming in as this has been moving sideways. I think this is an important indicator here to let you know that interest is picking up, and this base looks like it is going to be resolving to the upside at some point in the next year, would be my prediction. Could this take, could it hit 30, 31 again at some point later on this year and then have another attempt that's needed in 2018? Yes, absolutely it could. But these are the most important aspects of technical analysis that I use. I tend to make most of my charts in this way. So if you follow this channel, this is what you are going to see for a lot of my charts. Some charts I bring up other indicators. I didn't talk all that much about the RSI, the momentum indicator. I'll get into that another time. And oftentimes I will give target callouts, I will measure amplitudes, I will measure projections of Fibonacci retracements to give amplitudes, to give targets, and put those on here. Right now I wanted to make this video. Let's save that and close that so we could just look at it one more time. Here is the GDX from the peak to the trough, broken on the long-term trend line, impulsive move higher, volume picking up even as price has only fluctuated in this zone, initial rising trend here, working on a major resistance level. I am going to try to do some more of these videos in this way from time to time. We'll call these in-depth chart analysis videos, or basics of technical analysis, or the technical analysis system that works for me. If you find some value in this, and I hope, I know that there are a lot of advanced traders out there as well. Maybe you find some value in this. If you don't, I do apologize, but I find this big picture overview is the most important sometimes for looking at what we should expect in a market over the next year to 18 months. So if you found this helpful, if you'd like to see more videos like this, maybe not every week, but maybe when the markets are consolidating, give this a thumbs up. And that way I know that some people find value in this. If you didn't, tell me why. Tell me what doesn't make sense. I love to hear from people. I can't respond to every single comment, but I do try my best to take a look at them. And if there's a legitimate question or concern, I do try to respond to that. If this kind of system makes sense to you, if this is the type of technical analysis that you think would help you with your investing in the precious metals, this is what goes out weekly. The finished charts go out weekly to subscribers. We cover not only the GDX, the other mining indices, physical gold and silver, the individual miners that I am investing in here myself, as well as everything else that's impacting the precious metals, the currencies, the euro, the US dollar. We look at other commodities, the CRB commodity index. Everything that is impacting the metals is laid out in as clear a form as I am capable of. You can find out more to sign up with that on the main webpage. And if you have a unique situation that you would like an opinion on, an educated, researched opinion on the precious metals markets, know that I do work with individuals on a one-on-one basis. You can find more about that on the consultations tab on the homepage. Thank you very much again for watching. I'll be back next week, and if we have some stronger moves in the metals, I will put those into better perspective on the actual metals charts. Thanks, and have a lovely rest of your week.